Thank you for tuning into the Buyer's Guide podcast, where we talk all things property and finance. My name is Peter Mastriani, the founder of the Buyer's Guide, and in today's cast, we'll be discussing part two of our three-part series, which is focused on the overarching strategies involved within property investment, being passive, active, and alternative or emerging investment options. Now, following on from last week's discussion around passive investment, the focus will now shift to active property investment options. So, let's get to it. Development is an active approach to property investment as you're out in the market finding sites to do deals by turning them over quickly for a profit. This is in comparison to a passive property investment style of holding for a long period to achieve capital growth and also to reduce the overall debt position. Now, development does carry, quite a lot of risk, or there are a lot of associated risks towards development. So you need to firstly ascertain your actual risk profile to determine whether or not you actually have an appetite to pursue a venture such as this. Because for some, it may actually be better to pursue a safer, lower return investment strategy. So once you do that, the next thing is to really determine what strategy you're actually going to pursue and then ensure that you actually have the right structures wrapped around that strategy to work specifically for you. And doing so is going to impact on the overall tax payable on the profits that you do make or hopefully make. It's also going to impact on your ability to access that for private use, access the capital gains tax recessions as well, access to maybe losses made or even impact on your personal liability exposures. So it's very important that you focus on strategy because it will create tax efficiency, but it'll also mean that you don't get caught out. Because if you're doing something naughty and you end up getting caught out and get slugged with a 100k tax bill plus fines and interest because you maybe relied on misinformation or relied on a loophole that was probably or could be incorrectly applied, and if you're mid-development, this is going to create problems because not only will the banks be pissed, but your family will be worried, and the future of the project could, potentially end up on a knife's edge. There is liability issues as well. People do get sued, not often, but it certainly does happen. So those aspects are definitely worth being very mindful about. However, if you do feel that property development is going to be your pathway to success, there are several gates that you will need to pass through. Each of these has a potential for misstep, and property development isn't undertaken by the masses because I guess it could be overwhelming to a certain extent. Those that are not overwhelmed will certainly need a strong level of knowledge. They'll need to be doing some pretty slick research and planning. Otherwise, mistakes are going to definitely happen. With, I would suggest, maybe around about $200,000 worth of cash or equity, it's pretty reasonable to expect that you can get started within property development. Mind you, on top of this figure, you will also need an ongoing income for debt servicing. With that type of investment, though, you could invest into a syndicate or a joint venture, or undertake, your own small developments. Again, it depends on what intelligent and creative development strategies you can implement to increase your wealth position. Now, whatever strategy you do decide to pursue, there are going to be several main gates that you will need to proceed through. The first being advice and planning. So, get your house in order. Obtain some asset planning and strategic advice on the appropriate avenues to pursue. The next gate is obviously site acquisition. And finding investment grade sites is difficult. And if your strategy is to scroll through realestate.com.au listings, then you may have to find or determine a new approach. Good sites are increasingly becoming a rarity. Um, and they're extremely competitive. So, that initial sourcing part can be quite complex and time consuming. You do need to develop connections, negotiate on off-market transactions, prospect directly, and run suitable analysis on each opportunity before closing out on that deal. And you do need to be ready to act immediately when a suitable opportunity arises, because if you don't, someone else will, and that'll be another one that you will miss out on. A next stage that you will have to pass through is obviously development and planning. You need to have your specialist development team in place, which would include a project manager, and unless you plan to do that yourself, an architect, a town planner, an engineer, and so forth. Good accountant, good lawyer. You'll also have to pass through the development assessment, or the DA process. It'll need to be lodged and approved along with the building assessment, or the BA. Both are particularly detailed processes, and obviously you will require the associated specialist team around you. All going well, once you receive the green light on the DA and the BA, you can move towards construction. You can call for tenders, you can renovate it or detonate it, or maybe remove the existing dwelling, start the groundwork, start construction, and then you've got the ongoing management of that project. And then there's the after development. So looking at the sales, or perhaps the property management, depending if you're disposing or holding of the assets. You'll need to consider taxation, you'll need to understand your GST and your capital gains tax obligations as well. Again, you should have probably already covered this during the planning stage, and you may also need to take into account estate planning purposes as well. Now, property development can be a risky exercise, but those risks certainly can be mitigated, they can be reduced, and they can be managed. And they can be done by ensuring that your team has the essential experience and achievement that aligns with your strategy. Finding sites that suit the concept that you would like to implement, opposed to a concept that suits the site, could be a better avenue to pursue, because you could come unstuck pursuing a concept that you're not familiar with, or you could over leverage yourself as well. You just really need to ensure that you have a rock solid feasibility, and don't be afraid to maybe even fire someone if they're letting the team and the project down, because it's only going to impede on the results that you ultimately achieve. Also, buying property in the right zoning for your strategy is essential, because that way you really don't have to stress too much on not getting that development assessment through. So the more common developments that are undertaken are several, but there are a lot of creative and intelligent strategies that people do implement to generate wealth from an active property investment focus. Now, the strategy that they pursue will obviously depend on their own risk tolerances, their equity or their cash position. It'll also impact on their time and also resources available. And each strategy is going to vary in complexity and detail. Obviously, the higher the complexity, the more variables, and therefore the potential risk, which can offset the return. Now, the more common strategies do include a renovation or subdivision combined with a residential type development, whether that be sticking another house on the block or a granny flat or something like that, or maybe even remove the existing dwelling and build townhouses or units. Now, under these broad categories, there are several methods that can be applied to spin a profit or to manufacture equity and build wealth, which we'll now start discussing. So, if we're looking at things from a renovation perspective, the strategy has a lot going for it. Firstly, that there isn't a lot of barriers to entry. It can be, a relatively low risk process compared to, developing a set of townhouses, for example. So, on that rationale, the costs are more moderate, and timelines can certainly be um, expedited as well. Now, used as a strategy, renovation can, one, manufacture equity if you do intend to hold that property, and secondly, you could flip it in terms of buying, renovating it, and then on selling it as well. They're probably two of the more common strategies implemented if you do decide to move down a renovation path. Now, if your intention is to buy and hold the property, then a strategic renovation could be an excellent strategy to apply. Done right, rental yields could certainly increase, and equity in the dwelling should increase, which you can put to use to fund the purchase perhaps of another investment. Now, some important considerations to apply through your planning process is thinking about the structural integrity of the property. You'll need to think of approvals that may be required. Um, you'll have to think about whether or not the renovation will appeal to a broad base of potential renters or potential buyers. Are the renovations actually adding value to the property without overcapitalizing? If it's a unit or a townhouse, will there be body corporate issues that or special terms or conditions that will be applicable? And how are you going to finance the modifications, or what tax advantages, including depreciation, could be applied? How long will it take? Does the cash flow that you actually have support the renovations and that period of vacancy as well? So there are some important considerations, along with many others, that need to be given some considerable thought before moving down this venture. Now, an increasingly popular option is to build equity and improve cash flow is to actually build a granny flat. Now, obviously, this would be a suitable option for a detached dwelling. I think it would be hard pressed to get a body corporate to approve that one to sit in the back garden. However, a granny flat that is flat packed can be a relatively inexpensive process and built very quickly. Demountables or dongers, as commonly referred to in the mining industry, could make a great prefabricated home in the backyard. Pending planning approvals, of course, you can actually pick up some flat packs out of China for less than $10,000, or source it domestically for around about $80,000 and up. Installation and build costs are on top of that as well. Now, as a property investor, granny flats can allow you to earn higher or multiple incomes from that one property, which can sometimes be enough to turn a negatively geared property into a positively geared one, for example. And from a renter's perspective, though, it may not be for everyone. Some may be displeased to be sharing the property with a potential stranger. Alternatively, it could be the perfect option for a larger family, or for one that requires alternative living arrangements. Now, flipping is definitely commonplace. If you watch Channel 94, you'll see any number of shows, particularly out of North America. And look, arguably, I should say, flippers would be, pretty readily available compared to, finding investment grade development sites. Again, it is a lower risk, and moderate capital injections are going to be required, which does make it more appealing for individuals to make a start in pursuing an active investment strategy. Also, you don't necessarily have to worry about obtaining development assessments or building approvals or going through long protracted council approval processes, unless of course you're undertaking major structural changes and extensions. Now, the risks associated with flipping properties do center on time due to the holding costs and maybe even missing the mark. because you've maybe overcapitalized or um, overpaid for that property initially, not properly identifying the demographics of the region, or perhaps you've just had poor timing. And the list can go on for any other number of reasons. Now, cash flow considerations and accurate projections or forecasts do need to be maintained to ensure that you do achieve a profitable outcome. Again, obtaining any necessary approvals and meeting regulations, are an absolute must. But purchasing and selling and taxes should also be considered when buying and selling a property. So, the actual costs associated with this process can be quite high. But by sticking to a few rules, you should be able to secure, a profit, and that can be done by buying below market value. Um, you can upgrade and style really fast. The dwelling needs to obviously have street appeal, along with nice big ticket items such as a good family kitchen and good family bathroom. Um, Having to do anything structural can really blow out your costs. So at times it can be better to stick with existing layouts. But a new paint job, a new carpet, tiles, or polishing the floors, adding new blinds or curtains or fittings and fixtures can really have a dramatic cosmetic improvement to the overall property, which is really what you're after. Um, a lot of properties in this flipper type range are within the low to medium end of the market, because there is a larger pool of buyers to target. Secondly, it's less risky due to the capital outlay as well. But again, it's a competitive buyers market within that space where you're competing with other investors who may be looking to purchase property through their self-managed superannuation funds, or baby boomers looking for a new rental as a property investment, or even first home buyers getting into that 400 to 600,000, $650,000 price range. I think most importantly, though, it's really important to be realistic with your numbers and have conservative figures. Are always going to be best in these circumstances. So you need to maintain a budget and cash flow statements and really focus on your numbers. Now, the next thing that we'll discuss is subdivision. Subdivision, again, is a pretty common strategy that's employed by people that pursue a active property investment strategy. And subdivision does carry, a lot more complexity in comparison to, undertaking a strategic renovation, and that's because there are more risks and a longer time frame that's involved. But the rewards are potentially going to be greater as well. Now, if you are planning on utilizing subdivision as a strategy, you will need to proceed through around about 5 distinct stages. That being the advice and planning stage, the site acquisition, the development and planning stage, construction, and then post-development procedures. Now, very broadly, these will be gates that you will need to proceed through during the subdivision process, and like all things, variances will occur. Now, two main subdivision strategies are most commonly applied. One being that you acquire the site, you strip it or remove the existing dwelling to one portion of the block. Then you obtain the DA for a concept development, and you either decide to flog it off to someone else to complete the construction, or you can acquire the site, move the existing dwelling or clear the block, obtain approval, develop, sell, and or hold the new assets. Now, numerous activities can take place between these two options, and the variations largely sit in and around construction, and also the planning and development stage and that approvals process, depending on what needs to be done to the block to get it through that council process. Again, obviously this is going to be defined by your ultimate strategy and the concept and planning and the site requirements that are going to coexist. Now, legislation and rules do vary considerably from state to state and council to council across Australia. So, it's really important to consult with planning experts with expertise in that specific location that you're actually looking at doing the subdivision in. Now, for a generic overview of the subdivision process, the steps are acquisition, where you would go and do your due diligence and your research and planning and your purchase. The next being the planning and approvals, where you'd lodge the DA, you get the DA processed, and you have the application decision notice that would come through. The site prep is the third distinct stage, where operational works do commence along with other building activities. Next is that you obtain quotes and contracts, where you source builders and the trades and agree on contracts. Next is construction, so it's build stage, it's the project starts to finally take shape. And then is completion, where you get the plan sealed and the title registered, and then you look to offload those assets or hold them or do whatever it is that you intend to do. Now, if you do own the property and it fulfills the existing criteria listed above, you're going to be off to a really good start. Alternatively, you will need to search and complete due diligence on suitable sites, which should consist of looking at public transport, schools and education, shopping or retail areas, definitely the total land size area, the usable area of that block, the typography, the vegetation, the soil, stormwater, traffic, noise level, the actual availability of services, statutory authorities, planning and road access, statutory charges, services, and also title. So it's a pretty long list, but they're absolutely some of the key ones are obviously zoning. It's going to be an absolute key consideration, because it'll define the legal and the prohibited use of the land. Lot size, so there will be a requirement to have minimum square meterage, and apply different development for zoning purposes. There could be restrictions as well because of aspects such as flood prone land or stormwater, soil quality or native vegetation. Heritage could be another restriction as well. Overlays are another unique aspect that maybe needed to give some consideration to as well. And also future infrastructure planning as well, so planned infrastructure developments which could limit the use of the proposed development. Now, planning and approvals through the relevant local council can be a pretty time-consuming process, and applications need to be made to the actual specified guidelines. Now, this part needs to be spot on, because if you don't want the council to knock back the application because it's not to standard, outcomes from this are going to be substantial delays for incompleteness or perhaps forfeiture of part or the whole application fee as well. So it's really important to rely on a good town planning professional as opposed to trying to do this process yourself, unless you have pretty unique skills within this area. Now, planners are going to be of benefit to you because they're also going to be able to negotiate with the council and follow up on the application status once it's been lodged. The council will issue an acknowledgement which is relevant because of the date of which will provide the guidelines to the council to process the application. Again, this time frame does vary from council to council. Now, once the council is actually satisfied that the conditions will be met in terms of their requirements and legislation, they'll issue a decision notice which will include conditions, and approval will usually be valid from anywhere from 24 to 48 months pending the approval. This notice is essentially the T's and C's document which outlines the conditions that need to be fulfilled and finalized um, for the development and the specified times. So the next major milestone to be mindful of is the operational works, which is going to include the clearing of the block, earthworks, water, sewerage, stormwater, electrical connections, all need to be done. An engineer will need to assist during this stage as well to design and draft the proposed plans, which need to be lodged, and separate charges are going to be applied as well. So once you start progressing to clearing the block, you may need to demolish existing structures or remove concrete and look at other features from the main dwelling to make a decision on whether or not it's best to remove or demolish the existing dwellings. You'll need to look at driveways, curbs, and new fencing. All may be necessary. Now, once approval is received for the civils quotes, you'll need to be obtained from suitable contractors. There would be nothing stopping you obtaining quotes before approval as well. And quoting can be, a difficult task. So it's a good idea to obtain multiple quotes that accurately reflect the full requirements of the job in line with the council's requirements. So pricing can vary considerably, and the cheapest quotes may not necessarily be the best or the most accurate representation of the work that's actually going to be required. So, talk with your contractors and get into the nitty gritty, because the opposite will also be that overly expensive quotes could have unrequired work which may not be necessary. So engage with the most appropriate contractors, pay the deposits, obtain the work permits where necessary, and finally dirt will start to get pushed, concrete will be laid, and the frame will start going up, and for this process to run smoothly, it needs to be orchestrated to oversee, the efficiency of the actual works. You can never really rely on contractors, or else the job may never get done. If you do have the time, it can definitely be done yourself, or better yet, you could use a skilled project manager or a project management consultancy to really whip those contractors into shape. Also, you need to remember that it rains. The best schedules can be blown out due to weather constraints, so it's obviously worth making allowances for that as well. And after you fast forward several months, the work will be completed, let's say hypothetically, and that'll need final survey plans, and you'll need that for submission for the actual plan sealing. Largely, this is another administrative process to ensure compliance, that the T's and C's have been satisfied. Once the council has inspected, and the boxes are ticked, the survey plan is sealed, meaning that everything is in accordance, and new lot numbers can then be issued. Once the plan is sealed, it'll then be registered with the titles office, completing the process. So we've discussed renovation as a strategy. We've also discussed subdivision, and during subdivision we've also touched upon elements behind development. So let's continue to discuss that in a little bit more detail, because in development, taking a project from conception to site acquisition and through the design, the approval, the financing, the construction, the marketing and sales, or leasing, is a really highly orchestrated process. So attitude, education, experience, through to the things done right and through to the things that have been done wrong, attributes of really successful developers in terms of overcoming any number of risks and associated tasks where people can come unstuck in order to ensure that your development remains profitable. So look, anyone has the potential to make a fist of it in the development space. Now, the big boys complete the larger scale commercial and residential complexes, but most of the small to medium sized suburban developments are done by part time developers or investors who maintain full time jobs. And they're doing so to fast track their wealth pathways to success. If you're new to property development, starting small is probably always best. I originally started with a buy and hold strategy. Next was renovation and flipping. Now I concentrate on small lot developments. I think gradual steps over time is perhaps important because it could play to your lifestyle requirements and to your risk profile. And that's certainly been my approach. It doesn't necessarily mean it's right, but baby steps in some instances can be good. Um, and look, I'm sure that'll probably all change again in the future after there's future experience and other lessons that have been learned along the way. So there are 4 steps to development success: pre-feasibility in terms of finding that perfect site. Second being construction in terms of nailing it to time and budget constraints. Thirdly being actually managing your risk, and fourthly is deciding on a hold or crafting the appropriate exit strategy. So let's discuss pre-feasibility. You've found a prospective site with the right zoning, infrastructure, and lot size, and it's in the perfect location. Now, to secure it, it's pretty likely these days that you're going to have to pay at least fair market value. An offer of anything less then another developer could well likely snap it up. So now it's about knowing the numbers and ensuring you can obtain, probably at least a 20% margin. That way you can feel safe knowing that there's enough fat to cover any hiccups and missteps. Therefore, your preliminary feasibility needs to be accurate enough with estimates across your acquisition outlays, the actual DA process, your operational works, your construction works, the sealing and titles process, and finally selling costs as well, and any potential taxation or GST or capital gain implications that could come through in that time. So cash flow and accurate budgets really need solid maintenance during the build phase right through to completion, which now brings us through to construction. So when we look at the construction stage, the projects and numbers get larger and more complex. The construction steps will flow through the same gates. The first being the actual site preparation, so surveying and pegging for excavations and footings. Then services are installed. It's the leveling and the filling of the site and excavation for the footings. Then there's the base stage for the stumps or the floor slab. Then you've got your frame stage. This is where it'll actually start looking like something. The floor, the walls, the roof frames and the windows go in. Then you move to lockup. So brickworks or lighter weight material is applied to the eaves and the doors are going to be installed. So the dwelling is now lockable. Then you move on to stage 5, the fixing stage. So cabinets, bench tops, appliances, showers, baths, all those aspects will now be installed. And then you move to stage 6, which is completion. So the painting and the fittings and fixtures, the tiles, the carpets, landscaping, anything else that I guess is stipulated in the contract. Next will be variations. These will have been any adjustments that have been made during the process. They should have been agreed and obtained in writing as well. And builder's margin of variations will be somewhere around the 20% mark, give or take. And finally is acceptance and completion. So you walk through with the builder, you notify of any defects before actually taking possession, and again this should be in writing and signed off by both parties. So depending on what's agreed, the contract process payment will be due at initial acceptance, being the deposit stage, and base then the frame stage, the lockup stage, the fixing stage, and then the balance is going to be at completion. Now, once compliance certificates are obtained, the next decision is, whether or not you're going to sell or hold the asset. Realistically, you should know this well before this stage actually comes. Um, Better yet, you should probably implement the necessary aspects at the concept stage, even before the acquisition. So, choosing to sell will mean that you're going to realize your returns now, which also means that you may forfeit longer term capital appreciation. Now, as mentioned before, the challenge for property investors is managing exchange costs, because they're huge. When you buy, an additional 5%, sometimes more, of the purchase price will be necessary to cover all your different purchasing costs. Therefore, when you sell and realize the profits to put into the next site, much of the return will go into the purchasing costs of the next property. So a critical factor in determining success, as such, is looking carefully and thinking from the beginning right through to the desired end result that you would like to ultimately achieve. So, touching upon the aspect of looking at things from an end strategy in mind, also incorporates ownership structures. This is a huge topic in itself, and one that we'll cover in more detail in future podcasts. But joint venturing is definitely becoming more and more of a common scenario, particularly within the development space, as investors do engage with other partners, and they do so for various reasons. It could be finance, it could be knowledge or skills and expertise and resources. But joint venturing can definitely accelerate your growth and allows you to potentially hit your own goals sooner as well. Partners can help you to view things from a different perspective as well, or create win-win outcomes. And conversely, they could be more time consuming perhaps, because you've got situations that can change, resulting in deviations on your original plan, or worse, you could get involved with completely the wrong partner. But a new prospective partner realistically can come from any walk of life. They could be known through your social circles or professional, or you could network to meet these individuals through different property mentoring schemes that are available and are out there. The key is, I guess, to identify someone that brings some different skills yet shares a very similar property investment strategy to yourself. And success is going to be far more likely if you find a partner that you can trust, that you can communicate with, and maintain a relationship and an agreement through a memorandum of understanding, an MOU, and complete it before you actually find the deal. Now, you might be more commercially minded and organized, and better at structuring the finance and finalizing the exit strategy, while your new partner may be stronger on the project management delivery side. On paper, that could be a pretty strong duo. Alternatively, you could be a landowner sitting on a gold mine, yet lack the opportunity to realize its full potential, unless you find a partner that can share the burden of the planning and the construction costs. These methods could consist of an outright sale of the landowner, or sold in stages perhaps, and a development agreement and a joint venture agreement would then be implemented. Obviously, the interest will center around mutual profits that can be achieved, and the contribution of money or property or skills. Because of variances, negotiation is obviously going to be central, along with a structured legal agreement. Property lawyers will be able to draft up a JV agreement that sets out the individual's responsibilities, the rights, and defines the relationship with the minimal essential requirements. Also, joint venturing is not a partnership which would be classed as an entity. Therefore, it does require more liability and taxation implications as well. Now, legal structures established can be quite simple, through to sophisticated self-managed superannuation funds, through to family trust structures. Now, for this reason alone, professional expertise is required, particularly from a legal, an accounting, and a finance product selection and structure. A simple structure could be just held in joint names, where you have owner A and owner B holding a mutual asset. Therefore, borrowing will be assessed on the individual's capacity, and setup costs will be low with this kind of structure. The downside to this will center, I guess, around inefficiencies of asset protection and tax planning. A more complex structure could be to establish a property holding company, where the company would have their own ABN and submit a tax return, and the JV partners will own shares in the entity. Company tax, 30%, would be paid on the profits, and funds will then be distributed as franked dividends. Alternatively, a unit trust could be established for business activity. Thereby, the unit trust will then distribute the profits to the JV partners through their unit holdings, I should say. Again, what structure is best suited will be best defined by your legal and accounting specialist. In the not too distant future, like I said, we will be dedicating a podcast to ownership structures, so be sure to subscribe not to miss out on that one. Now, to cover all the necessary details on development as a topic, you know, we could take up the rest of the day. But for the time being, for the grounds that we have covered today, it's certainly a nice introduction to future podcasts on this exact topic. So remember to subscribe through iTunes to not miss out on any of the Buyer's Guide podcast shows, and reach out to us at www.thebuyersguide.com.au for your lending and property investment needs. So that's a wrap for today. Thanks for joining us once again, and until next time, bye bye.